Hi, folks. Alan Rohrbach here, President and Lead Analyst at Capital Markets Consultants, Rohr International. We are in the clarity business. And in fact, we've been through fluctuating forms of clarity or lack of clarity of late, as I pointed out a couple of weeks ago, as the S&P future was rallying up into some higher resistance. Clarity was a bit harder to come by because things were not, during this phase into the close 3 weeks ago, things were not really all that clear. There were still a lot of headwinds, but the market was anticipating what looked like better news. So 2 weeks ago, now this is the chart from the close last Friday, June 12th, and the market had dropped back down, but going back to 3 weeks ago and to 2 weeks ago, the market was anticipating better news to come and had some reasonably good news during the week. And then, of course, we hit the massive overshoot. Instead of losing jobs, quite a few, we gained jobs into that Friday, and it pushed it up out of the 3030 to 2970 key range all the way up to the 3200 area, where the key resistance was up into 3230. Now, as someone who has reservations about the overall potential for the equities, this left me kind of dislocated, much like there was an upside dislocation in the market. But the bottom line is, W.D. Gann said many years ago, don't fight the tape. And once we were above the 3030 area, all of this hefty congestion from back in July through September that was finally violated into last year, the market was talking to me. And as I always say, when the market's talking, you have to speak the language. And as we've noted before, this is the Rosetta Stone. And the technicals are the Rosetta Stone of market movement. The market's talking to you, you have to speak the language. This is a stone that was discovered during the French troop occupation of Egypt back in the very late 1700s. And the top two sections are different forms of Egyptian hieroglyphics. But that was something they were only guessing at back in those days. The bottom section is ancient Greek, which the Europeans of the late 18th century already knew well how to translate and interpret. So by comparing the stream of content that was communicated in ancient Greek, they were able to get a much better idea of what was being communicated with all of these Egyptian hieroglyphics, which had since become a dead language. So this was a major advance in archaeology, and this allowed them to eliminate a lot of uncertainty. Now, much like the market pushing above that 2970 to 3030 range, going back a couple of weeks ago, this eliminated the possibility it was going to head back down from the 3000 area in the near term. And as Holmes said to Watson in the fictional characterization of Sir Arthur Conan Doyle, who was, of course, the author of all of the Sherlock Holmes mysteries, in the analysis of a case that, he was correcting Watson from being over complimentary about how brilliant Holmes' analysis had been. And Holmes said to him, once you eliminate the impossible, whatever remains, no matter how improbable, must be the truth. Now, I misstated it last time. This is from chapter 1, and the proper name of that chapter is The Science of Deduction. Now, in the markets, it might be more like the science of inference, what we can infer, but still, that Rosetta Stone, the technicals telling you where to look, what is meaningful, and what might be just noise or less prominent decision levels along the way is very important. Now, especially important here is also the fact of what the next threshold might be. Once you decide the market's not heading down from the 3,000 area generally, 3030 to 2970, where do you look next? Well, once it was above there, based on the way it had gone up out of last fall through the winter into the February highs before the COVID-19 debacle, the next real resistance of any substance wasn't until 3,200 with a fine line area 3,230. And lo and behold, where did this market stop on the rally? Into the first half of next week. 3 days in a row, Monday, Tuesday, and Wednesday, in front of the Federal Reserve on Wednesday. And even once the OECD had released something we're going to review again momentarily on the macro side, it was the 3230 area. And only later on Wednesday, after Fed Chair Powell said, nope, I don't have anything else for you right now, did the market take his negative comments and the negative projections from OECD and start reacting. And lo and behold, by later on next week, by Thursday, it had broken all the way back down from the 3,200 area back to the 3,000 area. Now, to take a little closer look at this, because I do look at short-term charts still. I don't always use just the weekly charts as the technicals. I look at dailies. I'll focus down to hourlies when I want to get a very fine line view. You look back and say, well, what all went on back in December into early February? And the answer is, it wasn't just a couple points on a weekly. There was a lot of work, as it's called, a lot of lows and highs and closes left in the 3,200 to 3,230 area. And that formed the basis for, again, Monday, Tuesday, Wednesday of last week being up near 3030 before the market capitulated. Now, we have to ask about the macro factors, and that's why this week, starting out the week, there were a lot of things I had reviewed on separate days last week. Well, I did a particularly lengthy bit of analysis today to review all of that, because what's happening is the colossal cross currents have more complexity right now. It's not just that there are these cross currents between possible problems with the COVID-19 virus into hopeful reopenings in the US, and a complicating factor from COVID-19 rearing its ugly head again in China, where the supposition had been, well, this is now past it in China. They're showing you can fully recover, but suddenly there are restrictions again. There is also whatever after the openings and after all the government support, what happens when the government support is done and the businesses have to get back to thinking about what is my stabilized level of revenue from the business, to think about what they're going to need to do as far as permanent staffing levels, not just the staffing that probably drove some of that great job gains, those great job gains in the last employment report on the Paycheck Protection Program rehiring. So we're going to flip out of this slideshow momentarily. Oh, come now. I know there's supposed to be in these. There it is. I've got it. Pardon me. I'm going to show my toolbar so I can get back to my Rohr newsletters page on Ticker Talker. Now, this is in the alert. The alert is the shorter form of the analysis that also happens to include the US S&P 500 futures technicals. Now, the research note is the longer form that then carries on with the global govies, developed economy currencies against the US dollar, and the emerging currencies. Emerging currencies are very interesting because they are a very good barometer of the broader risk on or risk off mentality globally. But for right now, I even mentioned here, you'll notice that the complexity and subtleties of the major cross currents required that I become quite a bit more extensive in my analysis to discuss them. For one thing, are the greater number of cases of COVID-19, the infection right now, just the extension of the first wave into those areas that didn't have it before? Or are we seeing a real resurgence? Is there a second wave? And that makes a real difference. But if you want to review all of this extensive analysis, most days, not quite as long as this, you can subscribe to my newsletters. You're interested in only the S&P 500 along with the macro background, then which mentions a bit of the market movement, but also is mostly the background on the macro factors, then you can subscribe to the alert. If you want to go ahead and move along to a broader global, actual specific market analysis, US T-notes, gilts, German bunds, which we're going to touch on a bit later as to what the govies are telling us. You want the US dollar index along with the developed currencies and the emerging currencies, then you can subscribe to the research note. But for right now, we're going to go back to the PowerPoint presentation to once again proceed into what it is we've been seeing that is so daunting for the economies and the markets. And one of the things that we have to allow, again, on the macro side, eliminate the impossible. Of course, in the markets, it's always eliminate the improbable, because we never say anything's impossible in the market. Market can do whatever it wants at any time just because it decides I'm doing it, just like the push above 3,000 into what is still an overall troubling situation from, when it pushed up 2 weeks ago. But let's take a look once again at the world economy on a tightrope. This is from last Wednesday morning prior to the Fed, as provided by the Organization for Economic Cooperation and Development. This is the OECD. Now, I'll have a link to this at the end. I created a short link for your use. But look, the highly uncertain outlook, and also we know that there are these two possible scenarios. A one-off weakness because of the COVID-19 weight on the economies and the markets, or a secondary. And I thought it was important to highlight here that this is the trajectory they were looking at from 2019 prior to COVID-19. Now, the degree of the drop is just breathtaking. You don't normally get these kind of revisions, but you had a global shutdown. And the question now is whether we're going to continue, even on this lower trajectory to higher levels, or if we might just end up with a secondary dip. And that's what's so important. As I mentioned in the research note and in the alert on the macro background, what's so important about this period into mid to late June, because of the US reopenings from around the time in the end of May for the Memorial Day holiday. It was also a holiday. It was the late summer bank holiday in England. So a lot of group gatherings, a lot of people, as we know from the video we saw, that were not exercising proper virus suppression. No masks, no social distancing, etc. So this leaves us back looking at the ability for you to go ahead, and once you click into this short link, this is my evolution out of this entire long complex URL right here. When you use this short link, you will get to the same page we just saw, and you will be able to scroll down and also look at other things they provided. There was the full press conference from their chief economist. There is the full report, many pages long, with lots of interesting information and other links you can use. So by all means, copy this link if you care to and use it to your advantage. The full macro background. OECD, just as a point of interest, is not something I randomly picked out of the air because it supports my negative thesis at this time. This is a premier organization that comes up with monthly composite leading indicators that point out what the economy's looking to do. You know, the major economies of the different countries are looking to do over a 4 to 6 month forward view, and they tend to be more right than not. Now, can we use this for day trading or short-term swing trading? Of course not. This is the broader context that we like to have set, and what I've told you before. Top-down analysis. What's the longer-term economic context? Then we can get down to individual reports and where they fit in. What's the broader technical context? Because as you'll note, you know, we tend to go back, even on the daily charts, quite a ways. This is back out of November of last year, catching the end of the uptrend and the full swings in both directions. So, you know, when we're looking at this, eliminate the impossible, and what remains must be the truth. Is this market, having come up so far above the 3,000 area into this more meaningful resistance at 32 to 32.30, was it ready to essentially go back more or less to the highs from last February, right into that zone? And if not, well, it's going to react. Well, if it's going to react, where is it going to react to? Well, we see that there, you know, were wild swings back in early March based on the Fed's initial emergency intervention on March 3rd, Biden's ascendancy for the Democratic nomination, eliminating the socialist possibility, etc. But essentially, the market was trending down, and once it got back below 3,000 overall, it entered the bigger slide. Here as well, if the market should slip below 30.30 to 29.70, which is back down into this area right here, which it did temporarily last week, but early this week, but stabilized, and actually from the time we opened in the States was not below 29.70. If it starts closing below there, well, you might be going back to 2,600, but even looking at this daily chart and all the other, you know, work the market did in this range, it rallied in the mid-April and through May, into mid-May when it tried to turn down and not succeeding, pushed up to a new high for the rally. This means between 29.70, once it shows it's going to sustain activity below there, there's not much between 29.70. Some interim congestion, yes, but the next bigger level is back at 27.70. Now, what does this mean? Well, it was once again going back to 2008, the failure of the S&P back below the 1430 area, even left an upward reversal here as we got on December of 07 back above 1442, and everyone right in this time thought, well, that could be it. It held the earlier year low, it reversed up, but then into January gave all that up, and that turned into the resistance out into April and May, stopping at the 41-week average and heading down. But even if this market back then had temporarily gotten above the 41-week average, but then slid back below it, it still would have been a sign that there was a temporary overshoot on the upside and the market was trending lower. Well, that's very important for what we're doing now. Here's your 41-week average that was about 3,008 or so when the market pushed above it several weeks ago. And 2 weeks ago extended the rally. Now we're back down to it last week into early this week. So breaking back below 2970 would not just be a failure of some fairly prominent congestion and so forth. It would mean that the market was experiencing weakness back below the 41-week average. Another reason why, if it slips below there, yes, there's support at 2850, there's support at 2750. Now this plays right into the market holding around 2750 on the way up and then 2770. But the real big lower support that has not yet been retested is back in this 2600 level. So the market's had a heck of a recovery today. You saw the daily chart where it started out with the trading below 2970, but back above it. It has been back up. Let me take a quick look today, all the way to 3080. So that's a pretty good recovery. But the question more so is, as the news continue to unfold, the macro on the COVID-19, on the evolution of the overall economy, regardless of whether COVID-19 is more virulent or calms down a bit, that's what's important. If we start to drop below 2970, this market could be in trouble again. Now, again, I'm going to show you this on a shorter term chart because there was so much action. This high on the June future was 2965, going back to the very end of April, and it was part of a head and shoulders top pattern, broke out 2820. The channel up from the lows broke down at 2820. It was below the 18-day average for the first time in a while. At that phase, couldn't stay down, so that was the sign it's not going to top in here and let us go higher and ultimately pushed above this 3030 level. That also, though, means much below 2970, it's back in this whole lower range. And as such, we could start to think about getting back down into the low end of that area. Now, the other thing that is important, again, talking to us, listen to the market. I was bearish when it pushed above 3030 and on a fundamental basis, but I said, market's telling me wants to go higher. Whether someone bought it above 3030 for the push to 3230, or whether a bear just said, I just know I can't be short. I'm not going to sit here and be a charity for the Longs Retirement Fund. That was important. So getting back here, we have to ask also what was happening in the other asset classes. And what we see going back to the strength of the U.S. equities 2 weeks ago, what we had was the weakness of the T-note. First time in a while, after leaving this downside closing price reversal, new high, lower close from the 138 area, with the high 138.5 being the tolerance, and it held up above it, was back below it, possibly a sign of higher rates to come. Again, they move inversely. Lower prices on debt instruments mean higher rates. And instead, what we ended up with, sorry about the erratic cursor, but it disappears from my screen sometimes, so I have to get it back. Here we are back above 138 to 138.5 on the close last week. That says higher prices, lower yields. That says we're back to risk off. We're back to concerns about further weakness. The extreme example of that was the German boom. We had talked about this last week too. 2 weeks ago, the June boom, still the front month, with an early expiration that was last Monday, closed below the old important 170.5 to 170 area, but was back up above Monday. SEP contract, also an indication of anticipating future weakness, was back 3 points higher. So as soon as the June contract went off, we were looking at the SEP contract up into 173 to 173 and a half. And on the return of the anticipation of economic weakness, it has even pushed above the 175 to 175 and a half area again. So on a front month basis, even though we know there was a dislocation because of a premium, this is an interesting bellwether of concerns about maybe inflation, stronger economy, full reversal early last week with an extreme form of that by the end of last week. So once again, let's talk about, does this market, S&P 500 lead contract, which is going to be the September contract into the end of this week, does it hold on in the 3,000 area, maybe push back up for another test of 32 to 32.30, or go to even better levels on some psychology, or does further expansion of COVID-19, does worries about the stabilized level of business, even if the COVID-19 is not that prominent, and they're going to allow these states to remain open now, even if they get somewhat of a spread of the virus. That's what the governors have told us. But will the business levels be suppressed? Will the vulnerable populations avoid going out to retail and dining and air travel and hotel stays because of it? And that's still going to be bad for the economy and the markets, and we're just going to have to see. And at this point, again, those things are complex right now. I throw my hands up and say, hey, I don't actually believe I'm that smart. I'm going to let the market tell me, but I have to know how to listen. That's the Rosetta Stone factor. I think if the market starts closing below 29.70 again, it's going to be telling me that it wants to go lower and that the risk-off mentality is back. As long as it holds in this area, I have to allow it can go higher. It's all on even more so an unstable footing right now, and I bring you once again the fiddler, Chagall's green-faced man from 1924. You've heard this before. Sorry to bore you, but you always have to remember the fiddler is plying an exacting expertise on an unstable footing. I don't imagine anyone out there can argue. Even in quieter markets, we're doing the same thing. We're certainly doing it in this market. And that's pretty much it. Hope you've enjoyed the discussion, and I'll look forward to seeing you again on Ticker Talker TV. Until then, good hunting out.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Thank you for joining Roar International on Ticker Talker. We hope you found the insight beneficial and look forward to providing you further advantages sometime soon. Bye for now.